That's closing bell on Wall Street, and now it's market domination overtime. We're giving you full coverage of all the moves to get you up to speed on the action from today's trade. Yahoo Finance's Jared Blickery joining us now with the latest market action. Jared.
Well, score a win for the bulls. All three of the majors landed in positive territory. The Dow just kind of barely. Here is the one day. Let's dial this down to the intraday. There we go. Just closing with some small gains there. 47 points in the Dow, or 0.1%. Here's the NASDAQ composite. Tech did a little bit better today, up about 0.6%. And the S&P 500, a little bit less than that, 0.4%. You can see we were up by a lot more earlier in the day, but it ended up giving a lot of that back. Also want to point out the S&P 500 equal weighted index, where every stock gets one vote rather than just weighing those big stocks more. That was down today. That tells you that there was not great breadth in the market, that overall, I think it was some of the bigger names driving the price returns that we saw. Nevertheless, here is the sector action as we landed in after the close. Tech, XLK, the number one spot after leading down 2 days. That is up about 0.7%. You can see it's still changing there. Financials in second place, both of those outperforming. We also have industrials and materials in the green, so that spells a good day for the cyclicals, although consumer discretionary, another cyclical sector, just ended up barely in the red there. Energy down 1.28%. That was the worst performing sector. Also on its heels, utilities, staples, real estate. If you notice, all of those are defensive sectors. So it was actually a fairly, at the end of the day, it was a fairly decent day for the bulls. But as I said, the market breadth was not that great. We did see some outside performance from Alphabet and Broadcom, up 3% and 4% respectively, but let's just show Nvidia. That's what everybody's focused on right now. Here is that year-to-date chart, 186.52. We're going to tell you what, in 24 hours, what the price reaction is off of the most anticipated earnings announcement this season. And just drilling down into tech, as I like to do, here are the semiconductors. Pretty broadly good day here. AMD whiffing, that was down 3%. Micron down about 1%. And then taking a look at software, we had some big names in the red, and arguably not nearly as good as the semiconductors here. And we'll also take a look at some of the smaller names in disruption. As I said, this was not a broadly good day for a lot of stocks. You can also see that in the meme stock basket, but I'm going to have to leave it there, and I will send it back to you, Josh.
Thank you, Jared. Well, 2025 has been a year riddled with policy shocks and uncertainty, yet the S&P 500 on track to end the year higher. That bodes well for 2026 as TD Securities forecasts fewer shocks and ongoing risks. Rich Kelly, TD Securities head of global strategy, joining us now with a closer look. Rich, it is great to see you. I think you probably could guess, Rich, where I got to start with you, which is Nvidia earnings on deck. The face of the AI trade, Rich, $4.5 trillion market cap. How important is this print for the market, Rich?
I mean, for the market, it's massive, right? I mean, this is the focal point as you're looking to what has been the conversation, in part because, we haven't had a lot to look at with the government shutdown and no real data coming through. But I mean, this is one of the critical innovations that is sort of rewiring the entire global economy. So you have to look in there. And we know there's a lot of funding and financing that's tied up in this. I do question a bit of the overhype in terms of how important it is for the economy right this second. I think it's a very long-term story, but the market is fixated on this number, and that's just how it is.
That's interesting, Rich, because I've seen other economists say they believe AI is very important to the economy. They say really it's AI and it's the wealthy consumer.
I mean, it's going to be transformational. Like, I think from that side of things, I'm definitely a full believer in terms of where these things go. But I mean, our own analysis, you look in, it's a large share of the growth of capital investment going on, which is one part of what feeds into GDP. If we want to look into the broad economy and we want to talk about, that portfolio that is the entirety of what's going on in the US, in terms of the growth of business investment, that is a large share. However, if you go into that, it's crowding out a lot of other investment. So there's other things that would happen if that wasn't going in there. If you look at the content that's supporting that, our analysis shows a significant part of that is imported content. So when you look at the accounting that goes into GDP, you're only getting maybe a tenth or two in terms of GDP growth that's actually getting into this. So that it is a growing stock over time. It's a very important part of one of the engines of US economic growth. But I think this is still a very diversified economy with other areas. I think there still isn't as much leverage. There isn't as much, kind of finance financing that would get you into more precarious areas. There are other fallbacks that go into there. So I'm just not as wary in terms of, what sort of how this is built up into the overall side of the global economy right now.
On that economy, Rich, you tell clients you expect growth to beat consensus expectations for 2026. How come, Rich? What will sort of drive that resilience?
Well, I think we saw over the last year, it was certainly about the policy uncertainty and which road we were going down. I think we've seen a lot of that delivered. Now it's about implementation risk. And you're already starting to see some of the tariffs start to roll back. You're seeing firms adjust. I do think you've only seen part of the adjustment to tariffs and trade changes that have come through. I think you've only seen part of the changes of AI that's coming off. But I also think you haven't seen all of the easing that the Fed's going to deliver and start to put some of that through. I do think over the next 3 to 6 months, you're probably going to see a bit more weak data. We'll get payrolls tomorrow for the first time in a while. We actually think that's going to beat consensus, but I think the next 2 prints after that are probably going to be subpar, maybe even around zero. So the near-term data is not great. Inflation, yes, is running above target, but I think you'll get more Fed easing. I think you will see some of this balance come through. I think at the margin, you're just in a higher cost world. You're in a lower neutral growth world. And that has implications in terms of what we can do. But I think as you move through next year, I just think consensus, when you look at what's out there across economists, I think it's too pessimistic in terms of how slow U.S. economic growth will be. I think you'll see a bit more resiliency, especially if you're looking at Asia and China. I think at the end of the year, I think you can see U.S. inflation come in a little bit better than where consensus is sitting now. It's going to still be very sticky in the front half of the year. We're still seeing adjustment. But I think as you move through the year, I do think there's areas where the U.S. can outperform, Asia can outperform, and I think that can get us to, a year that looks very similar to this year if you're looking across fixed income markets, 50, 60 basis points lower in 10-year treasuries in terms of lower U.S. dollar. I think that's probably the trajectory we're on next year, and that can support risk overall.
I thought your comments, Rich, on the dollar were interesting, where you call for a structural decline in the U.S. dollar next year. How come, Rich? Why does the dollar weaken even as the economy stays resilient?
Well, I think this is the bit. I mean, if you look in FX markets, it's all about the dollar smile. You need dollar exceptionalism, or you need the world really falling off a cliff to get you into that strong dollar. Once you're in the middle zone of whether it's decent growth, whether it's resiliency overall, whether it's relative stability, that tends to be a market that's just engineered for a bit of a lower dollar. So I think that's one side of things. I think that is the area overall growth, overall risk sentiment, where we're probably on average going to be setting across the year. I think the other side, while I do think the Fed can continue easing, I think the conversation over the next year for the ECB, for the Bank of Canada, for the Reserve Bank of Australia, a number of other central banks is going to be, when's the time to start hiking? They delivered a significant amount of easing over the course of this year while the Fed was patient. They can sit there on pause. They can sit there and start to think about when hikes can come later on next year. And it might only be the ECB, but I think that conversation will be on one side. That leaves interest rates outside the world pushing a little bit higher, a bit more supported, and it leaves interest rates in the US going down. So it gives you interest rate differentials that are giving you a weaker dollar overall. We do push back. I think there's this question of dollar debasement and de-dollarization. I think that's probably overhyped a bit. What we're actually seeing is a very structural change in hedging markets in terms of what's going on and how people are hedging the downside. So I think there's a lot less selling of US assets than people let on. I think at the margin where they have to buy new assets, they're certainly skewing away from dollars that they might have bought in the past into other areas. But I think overall, they tend to be holding on to assets, but hedging some of the risk. And as the Fed cuts interest rates, the costs of hedging goes down and you can get more hedging coming in. And that in itself can support a weaker dollar as well.
I want to end here, Rich, on your call on commodities, because you say here looking ahead, gold, copper, crude, you say, perform above expectations. What drives that kind of constructive view on the complex, Rich?
I think if you look at precious metals, gold in particular, you've had a structural trend over some time in terms of official money coming into gold. Certainly, you've got people looking for diversification. That's an area goes off. And just simply some of the structural bits, look at all the volatility we had in silver in terms of the movements between the London and the US. I think those sorts of structural changes are going through as well. So I think that can support you to new highs when you're looking at gold, probably upwards of something like $4,400. I think oil is something, the amazing thing there is that it's not lower with the the amount of massive supply on the world, you haven't seen that push lower. I think you probably find a bottom in the front half of the year and start to have oil prices dip up as you go through the rest of the year. And I think base metals just overall, and copper and others are just going to track the overall U.S. economy. And if we're starting to see some sort of rebound in Asia, if you're starting to see restocking there, that gives you that support there as well.
Rich, we covered a lot of ground, my friend. Thank you. Appreciate it.
My pleasure. Thank you.
We're expecting Nvidia's third quarter results soon. Here's what some of Wall Street's top analysts and strategists are expecting from that report.
I think it's very important because it is the leader of the pack. And if the leader of the pack stumbles, then in a sense, the other members will trip over it. Well, our analyst, Angelo Zino, thinks that we're going to be seeing Nvidia beat the October quarter consensus numbers by at least $1 billion. So expectations, the bar is set relatively high, but we think Nvidia will eclipse it.
I mean, it's a macro indicator at this point. It's hard for me to imagine, given the sentiment today, that we can see an upside surprise. The concern is even if they do blow it out, that investors are still going to be skittish, just because that's the sentiment in the markets today. So I think it is very critical. I'm not sure, though, even if it's a strong report, that it's necessarily going to tip the scales in favor of a market rally.
Street is looking for about $62 billion in revenue for Q4. Typically, Nvidia guides up, call it kind of 2 to 3% on the street. I think they probably do something like that, maybe even a little bit better. And I think that's probably a relief, certainly given what's going on in the AI trade right now. The second thing, though, is this $500 billion number that Jensen put out at GTC just a few weeks ago. He said they have $500 billion in demand between this year and next. And if you kind of do the math on that, there's like 10 percentage points in growth upside to where the street's at for revenue next year.
Jensen's comments in Washington, he's talking about booked business, booked Blackwell and Rubin business over 2025 and 2026 cumulative. That's 500 billion of booked business that Nvidia has. And if you look at the sequential trajectory that this implies for the business, it implies that Nvidia is going to grow its data center revenues, close to 20% sequentially every quarter from now until the end of 2026. And if you look at expectations, actually at consensus expectations, they definitely don't reflect that kind of upside. So that's one thing. And then if you look at things from another angle, if you look at it top down and how much Nvidia's major customers are planning to invest, so like the capex plans of Amazon, of Google, of Microsoft, of Meta, actually they're very consistent with such a sequential trajectory. So bottom line is we think that the setup is looking very good for Nvidia from multiple angles for the coming quarter and entering 2026.
Nvidia is by far the largest supplier in the market. So I think what they tell us is going to really be a good indicator of where AI spending is right now. And I think they're going to have very positive things to say. So we've done checks in Taiwan. The Taiwanese supply chain is continuing to see upward momentum. Had conversations with people selling into their products in the US. The same thing. We've heard it publicly from the CSPs, right? They are spending more on AI. You've heard from companies like Supermicro, where they're expecting sales to roughly double Q on Q, tied to better shipments of pretty much NVIDIA AI racks. And so I think NVIDIA is going to have really positive things to say about Q3, Q4.
When it comes to NVIDIA, the godfather of AI, there's only one of them, and that's Jensen. Look, demand to supply is 10 to 1 for NVIDIA chips. Get the popcorn out, get the watch parties out for next week's earnings, because this, in my opinion, is going to be a $6 trillion market cap in 2026. And again, the bears will continue to yell from hibernation caves. They'll be wrong.
Palo Alto Networks, first quarter earnings. They're just now crossing the wire here. Let's get you those results. Q1 adjusted EPS, 93 cents. The street was at 90 cents. Q1 revenue, $2.5 billion versus an estimate of $2.46 billion. More importantly, let's look at the guidance. Q2 adjusted EPS, they're calling for between 93 cents to 95 cents. The street was at 93 cents. At least initially here, it looks like it's down a bit in the after hours. I'm just looking for some commentary from the CEO. There it is. There's Nikesh Arora. He's talking about a strong start to the fiscal year marked by excellent results. He talks about strategic acquisitions of CyberArk and Chronosphere that he says positions us as the data and security partner of choice in this new AI era. Looking ahead to full year results as well, I wanted to see what they're guiding there for. It looks like they are seeing full year revenue, they're calling for 10.5 to 10.54 billion. They had seen 10.48 to 10.53 billion, and that acquisition will be in the headlines as well. They are buying Chronosphere, they say, for 3.35 billion. I know there had been some questions on the street heading into the print about the government shutdown, how that may have impacted the results. That's going to come up on the call. Most on the street like this name, the vast majority, in fact. You'll hear bulls talk about market leadership, expanding portfolio, the broad network, they'll say, of channel partners. At least initially, though, that stock down about 5% here in the after hours. Nvidia third quarter earnings, they are just now crossing the wire. Let's get you those numbers. Start with Q3. EPS of 130. I don't see a compare there yet, but Q3 revenue, 57.01 billion. The street was at 55.19 billion. Q3 data center revenue, 51.2 billion. That's a beat. The street was at 49.34 billion. Turning ahead, I'm looking for the guidance. Q4 revenue, they're calling for 65 billion plus or minus 2%. The estimate was at 62 billion there. And Q4 gross margins, they're calling for 75%. The estimate was at 74.6%. Jensen Huang, some commentary coming out there saying cloud GPUs are sold out, just highlighting the demand he's seeing there. Remember, interestingly, this stock heading into this print, it was up about 40% year to date, but it had been roughly flat since they last reported. And we know investors had these increasing concerns about AI trade, AI valuations, but at least initially here, this stock is popping almost 5%. Investors, of course, not just focused on this print, but they look to Nvidia for lines of sight into how sustainable they think this great AI trade and theme could really be. And at least initially here, they are bidding up Nvidia. We're up about 4.5% here in the after hours off this print. Well, for more on Nvidia's latest quarter, let's get directly here to CFRA Research Senior VP and Equity Analyst Angelo Zino. At least initially here, investors like what they see. The stock is popping, but what do you see, Angelo?
Yeah, so Josh, just based on the numbers that you just threw out there, I think the numbers were great. You're looking at the numbers as far as revenue, about 57 billion or so. I think we're looking at about 56 billion on earnings, about $1.29. So I think Street was $1.25. So they did beat the Street. As far as the guide, we were looking closer to 61, 62 billion, and they definitely came well ahead of that. And then I'd say as far as the data center numbers you provided. Also kind of beat both for the October quarter as well as the I guess expected January quarter guide. And I'd also say as far as gross margins are concerned, kind of going closer towards 75 there. Our expectation was 73.5 this quarter, 74.5 for the January quarter. So I think the fact that you're getting the upside to the revenue, but also kind of the nice kind of uplift with margins is something that I think is gravitating well with investors right here after hours.
Yeah, Angelo, we as investors who make a beeline, as you said, for that data center segment, that Q3 data center revenue, again, just to emphasize, 51.2, Street was at 49.34. As you look ahead, Angelo, how do you try and forecast what growth and margins could look like for that segment ahead?
Yeah, I mean, listen, I think when you kind of look for the company here, I mean, about 90% of the revenue right now roughly is coming from data centers. So the company is essentially completely being driven by data centers. The fact that we remain supply constrained here, which we think will persist through 2026, and just based on the bookings that we saw here from the hyperscalers, specifically maybe the ones I'm alluding to are Microsoft and Alphabet after Q3 earnings season, essentially in our view means that it's going to be fairly supply constrained through next year and probably well through 2027, if not all of 27. So that's going to bode well for the data center revenue potential as well as the margin trajectory. We think margins will be able to be sustained at that mid-70s level here for the foreseeable future.
More broadly, Angelo, I'm just looking at the revenue forecast for the current period. That's a strong forecast relative to expectations. I'm wondering how much you think that that addresses, some of these concerns, Angelo, broader concerns that had been bubbling up about the AI trade?
So it probably doesn't address the concerns as much as we'd like it to address the concerns. I think the concerns are more laid out into 2027 and beyond, right? So, as far as this quarter is concerned, I think most out there anticipated a beat for the quarter as well as a strong guide. I think the whisper numbers were closer to 64 billion, so even about a billion above the whisper numbers. So, but that being said, you kind of you look at the trajectory here over the next couple of quarters. You're going to get a deceleration in terms of the revenue levels. But when you kind of look at what Jensen alluded to back at GTC DC about 3-4 weeks ago, and the fact that you were talking about, a $500 billion backlog or so, I mean, these type of numbers are consistent with that. So I think the numbers go up, across the street here over the next 12 months. But again, expect some deceleration just because the law numbers are getting a little bit crazy here.
Angelo, as a bull on the name, as I said, since they last reported, we were roughly flat, but it was up about 40% year to date heading into this print. I know you got a buy on the name. How do you think about valuation for Nvidia?
So valuation actually, is pretty it's pretty attractive here relative to historical levels. I mean, you're looking at about 21 times, before the print here, 21, 22 times on a calendar 27 basis. So actually one of the cheaper names across, the larger cap stocks, tech stocks here. But our view is, again, this is going to be more dictated on the free cash flow potential of this company long term, and we think the upside in terms of the free cash flow potential is significant here over the next 8 to 12 quarters. So our view is there's a lot of noise right now. The narrative has definitely changed a bit for AI as they kind of start focusing on the actual execution and not necessarily the bookings growth that we've seen here over the last couple of years. And we think there's going to be more issues as far as the execution is concerned, as far as these AI infrastructure builds going into 2026. But nonetheless, the earnings power supports the fact that multiples should go higher here over the next year, as well as the fact that free cash flow we think is going to go significantly higher.
Angelo, we always appreciate your time, that instant analysis, my friend. Thank you.